Well, welcome everyone, and we thank you for attending our webinar today. I don't know, so for some people it might be morning, some people it might be afternoon, and some people it might be late at night. So for all of you joining us today, thank you and for your time and welcome. I will make introductions in a second, but before I get to that, I'd like to just cover a few admin issues for all of you. First of all, this is a recorded session, so if you don't want to be seen or heard, turn off your mics, turn off your videos. Uh, with time permitting, we'll try to have a Q&A at the end. So we ask that you hold all questions to the end, and we will try to answer them. And if not, you can always reach us after the webinar and send us your questions directly or call us. We do have a privacy policy. We don't sell your information because it's not worth very much. So we don't sell it. And but if you do have questions about our privacy policy, you can look it up. It's available on our website. Importantly, big disclaimer, we got lawyers. This is for informational and discussion purposes only. Nothing here should be construed as legal or tax advice for any particular matter. And we mean that seriously because actually we want to give you information here, but it's very hard to say without knowing all the facts and circumstances, what the actual answer is. So please just use this as for information. And if you have specific questions, Amy and I later will be happy to discuss those with you specifically. I've had to unfortunately add this fifth item, which is that we ask no minors be on this webinar. This is due to Amy, due to past webinars and inappropriate language and possibly sexual content. So if you are a minor, please leave. Thank you for that, Amy. She's been known to drop an F-bomb here and there.
Yeah, no. Okay.
But with that, let me introduce you to Amy Jettel. Quite frankly, it's an honor to have Amy here. She is truly an expert in this area. I like to call her Miss Sparty Pants because she's one of the few people that actually catches stuff that for me and points out things to me. So I've learned from her. I could probably spend the rest of this webinar going through her entire bio and background of all her accomplishments, but I'll try to summarize it very quickly. She's an expert in international taxation. She's an attorney. She is part of the prestigious American College of Trust and Estate Council, and she's also a board member of STEP, the Society of Trust and Estate Planners. A quick introduction to myself as well. While Amy was earning all these various accolades and doing all her writing and erudite studying, I started out my career with the IRS as a trial attorney. So I was a street fighter doing litigation. And then I went to the rough streets of Zurich, Switzerland, where I was doing battle with voluntary disclosure matters and heavily involved in that for about 10 years while I lived in Switzerland. Came back to the United States, then commuted to Switzerland for another 5 years, and now I'm here in the US. So I bring that experience to the table as well. So I will now begin with the actual presentation, which is US taxation of foreign trust. This is a boot camp, high level. None of you should hopefully be going home and starting to give advice in this area. If you do, then Amy and I are pretty amazing. But really, this is just to give an overview for people who are involved with foreign trusts and how the U.S. taxes those. Very high level. Hopefully, you get something valuable out of this. And I am going to cover part one, which is an introduction to the classification of trusts. I'm going to try and do that in 10 minutes, starting now. Why is this important? It's important because once you've classified the trust, all the other parts of the puzzle fall into place. So even though it's a fundamental and basic item, the classification of trust for US tax purposes is fundamental for all further analysis. And it's really broken up into three main parts. So if you walk away with nothing else, these are the three things you might just want to kind of retain. The first question is kind of sometimes seems obvious, but we'll get into a very quick overview. Is this a trust or is it not a trust for US tax purposes? So that's the first question we have to ask. More likely than not, if you're in this, we're dealing with a trust, but there's some nuances there. Then the next classification step is it a domestic trust or a foreign trust? Amy's going to cover a little bit more of that because we're focusing on foreign trust, but that's the second step in the analysis, in the initial analysis, domestic versus foreign. And I use foreign in the sense of the US term foreign. What we mean here is in general non-US, but foreign can also mean trusts that are created in the US but are classified as foreign for US tax purposes. And we'll just briefly touch upon how that's determined. And then the last item is whether it's a foreign grantor or foreign non-grantor trust for classification purposes, which has tax ramifications. And so let me just touch upon quickly, is it a trust or is it not a trust? The main point here is the US tax rules do not explicitly define what is a trust. So it's really based on facts and circumstances. The main items that you look for whether it's a trust for US tax purposes is there a fiduciary arrangement? Does a trustee manage assets? Are the beneficiaries passive? Because we're dealing with foreign trusts and sometimes jurisdictions outside of the US, and we deal with other things that aren't specifically defined as trust, we have to still somehow fit those into this category of, is it a trust for US tax purposes? And that's where we get into the nuances where you have a Mexican land trust. Thanks to Amy and this revenue ruling, which is based on a client where she did a PLR ruling, we now have a more definitive rule that a Mexican land trust is not a trust for US tax purposes. So thank you, Amy. Made that much clearer for us all. Then we have in Liechtenstein, we have the Stiftungen or Anstalts, which are similar to foundations in the civil law countries in Latin America. So those can be looked at in general if they're a for passing assets to the next generation, they're usually classified as a trust. And then usufructs. The one thing I like about this is that it's not as clear. Again, it's very much facts and circumstances, but sometimes not having clear definitions or clear guidance gives opportunities for planning. So sometimes it's good to not know what it is. It gives us flexibility. Some people don't like that. I do. I know Amy does. Okay, so we assume we're going to have a trust here. Okay, then now we have a trust. Is it foreign or is it domestic? And why is that important? Because it turns on how it's going to be taxed for US tax purposes. And here's the interesting thing. By default, under US tax rules, a trust, once it's determined to be a trust, is by default a foreign trust for US tax purposes. And it only becomes a domestic trust for US tax purposes if it meets two things, a court test and a control test. And I'll just touch upon those. So just repeat that. All trusts for US tax purposes are foreign unless it meets the court test or control test. It's a unique rule. I don't know if any other jurisdiction has something like that. Amy, do you know? I don't know. I don't think so. Yeah, I didn't think so. Anyway, quickly, the court test. What that means is that a US court has primary supervision over the trust administration. Very simple. If you have a trust that is subject to Wyoming law, that would be in general, meet the court test, unless there's these little nuances if there's a migration clause or something. But in general, if it's subject to a U.S. court with primary jurisdiction, it meets the court test. So that's part one, but it also has to meet part two. Part two is the control test, substantial decisions, meaning all main substantial decisions like selecting the trustee, making distributions, investments. That can be sometimes tricky. I'll just explain that. Allocations. Those are all substantial decisions. If those are not controlled by US persons or a majority of US persons, then you fail it. So it must be court test and control test for substantial decisions in order for it to be defined as a domestic trust. Otherwise, it's a foreign trust. Now, quickly, that again here, this gives you opportunities because of these rules. Depending if you come ahead of time and you want to plan these and you get advice in advance, we can use these rules to our advantage because if we can determine what we want the outcome to be, do we want it to be a domestic trust? Do we want it to be a foreign trust? Because there may be advantages depending on the situation. However, where you don't want to be, you don't plan, and then you find out by, I've got a foreign trust when I thought I had a domestic trust. I'll give you an example. There was a trust where it was domestic. They thought it was a domestic trust, but one of the individuals involved in the trust had investing control. It was a non-US person. It defaulted unintentionally to becoming a foreign trust. Not good.
And in that case, you're talking about under the terms of the trust documents, a foreign person had investment control. We're not talking about the trustee hiring an investment manager.
Correct. Right. This was it. Yes. Thank you for making that clarification. Yes. It was where an individual who was a non-US person under the trust had control to make investment decisions, and it defaulted unintentionally into that. So as Amy would say, no bueno.
No bueno.
No bueno. All right. Then we get into, we're focusing here on it's a trust. It's a foreign trust because we're talking about foreign trust today. We're not talking about domestic trust. So it's failed either or the test. And ideally, we've done it intentionally, not by mistake, but we can fix that also if that happens. And then the question becomes, is it a grantor trust or foreign non-grantor trust? I'm not going to steal Amy's thunder here, because that gets into what happens with the tax consequences. What I will just simply say, big picture, is that grantor trusts are basically the taxation flows through. And if it's a non-US settlor of a foreign trust, that's kind of the nirvana. If it's a US settlor, it's kind of tax neutral. And if it's a foreign non-grantor trust, it could be potentially hell. But Amy's going to go through that fun stuff with you.
I am? No.
Oh, yeah, surprise.
I can't remember what I'm talking about. I'll know when we get there.
So I'm not going to go through the key concepts here, but they're here in the slides, which we'll share with you after the presentation, as well as the recording. Amy's going to go into them into more detail. But so the main categories are foreign grantor trust with a US grantor. By default, that's going to be a grantor trust. Then the other one that Amy's going to cover is a foreign grantor trust with a non-US grantor. This is nirvana from a US tax perspective for the most part, because there's no US taxation. Amy, didn't mean, spoiler alert, didn't mean to steal that from you. And then US taxation of a foreign non-grantor trust. This is where the fun begins because it gets complicated. All right. Last item, we just wanted to mention it because sometimes it comes up, simple versus complex trust. It really matters more in the domestic world. For this purpose, basically, most foreign trusts are going to be complex trusts, okay? That's all you need to know. Nice summary here. If you guys really want to get into it, this is a little cheat sheet for you to have if you ever need it. And now, without further ado, I hand it over to you, Amy, on the U.S. taxation, foreign grantor trust, and non-grantor trust.
Okay. All right. And you're moving the slides, right? Okay.
I have the slide. Yep. So
Yeah.
if I'm
And I mean,
mess
you and I
up,
have
let
done
me
this
know.
presentation a few times, but since then the new Taylor Swift album came out and I'm completely out of practice. Like, yeah, but I know all the lyrics at this point. So,
Good.
okay. So
Maybe you
this
can
is where I
sing one
say,
for us at the end. You can sing something for us.
okay, this is a narrative version of the next slide, right? Is that where I'm at?
Correct. That's
Okay.
narrative's perversion.
Yeah.
Correct.
And so the next slide is just it's picture version of the previous slide. I like to talk in pictures. Okay. So Milan laid the groundwork for, we've got so this is the first classification of a trust. We have a foreign trust, foreign grantor trust that has a US grantor. And remember that there's we call it the automatic rule. If a US person creates a foreign trust that has US beneficiaries, boom, it's a grantor trust under 679, no matter what types of controls or interests the US grantor retains in the trust. If somehow you're able to draft around that classification, then you would still look at the terms of the trust to see if you draft yourself out of 679, you don't automatically have a foreign non-grantor trust. You still have to look at the other grantor trust rules to determine whether the U.S. person is treated as the owner of that trust. So, all right, for the purpose of this slide, we're going to assume that we have a foreign trust with a U.S. owner. The result of that is that I tell clients, basically the trust is kind of disregarded, essentially for tax purposes. All of the trust income deductions, everything passes through to the U.S. grantor, who must report it on their personal U.S. income tax return each year and file a whole bunch of other forms that we're going to go through really quickly at the end. And I think that's all I have to say about.
Yeah, I just want to add one point on the automatic rule, Amy, because this happened with 679, as Amy pointed out, that if you have U.S. beneficiaries, automatically, if you have a U.S. settlor grant, and we use grantor for under U.S. terms, what we mean also settlor, they're synonymous here, is that it doesn't necessarily have to have a U.S. beneficiary if it permits U.S. beneficiaries. So
if it could possibly have a U.S. beneficiary, So I'm in the middle of preparing UK trusts or working with UK counsel for a US client to create UK trusts for her UK nieces. And we had, I had to go and, say no US person can ever be a beneficiary or added, so.
Right. So I will go to, this is the text. And do you want me to go straight to the slide?
Yeah, so this is the narrative of the next slide, which is, hang on, let me see if this question that we have.
Yeah, maybe you can answer it quickly.
Let me look here. If I know how to work my computer. There we go.
Right. Where's Joe?
Okay. What if the co-trustee is U.S. based alongside a foreign trustee, which makes all substantial decisions? Oh, did you plant this question in the audience?
No,
Milan?
it's a good one. No, yeah. I didn't. It's a great question.
Yeah. So this is what we would typically call a hybrid trust. And we'll talk about this at the very, very end when we kind of go through special circumstances. But let me just say that, yes, there is a way to draft a trust instrument and administer a trust in a way that a foreign co-trustee can be appointed. And so, but it's all the devil is in the details. So if you have questions about the provisions and whatnot, feel free to email me directly and I can kind of help you with that. But just high level to answer your question, yes, we can make it meet the control test in that regard. So, okie dokie.
Great question.
Closing the chat. Yeah, thank you so much. All right, so here we are in the graphic depiction of the previous slide, which is we have, I think, is this one we call Nirvana? This is our Nirvana.
That's a, yeah, I call it Nirvana.
Situation. Yes.
It's so my Buddhism.
Yeah, our foreign trust with a non-U.S. owner. So, all right, so the IRS and Congress sees, well, you can imagine. I mean, it's like if you've got a foreign person treated as the owner of a trust, of foreign trust assets, then all of the income of the trust is deemed to be attributed to that foreign person. But that foreign person doesn't pay tax, right? on only on certain types of U.S. source income. And so because of that, the code and regs have limited the instances in which we will be granted this gift of a structure, this nirvana structure, to only two. One is basically the trust has to be revocable by, or revocable, however you want to pronounce it, by the foreign settlor, or the foreign grantor is the only beneficiary, or grantor spouse only beneficiary during their life. A lot of times we can't do that because of the home country taxation. It doesn't work. So, but if we can get into nirvana land, then here is the consequence. If you have a foreign person treated as the owner of this foreign grantor trust, then all the income, whatnot, is attributed to the foreign owner, and no U.S. tax returns, no U.S. tax, except for those things that non-resident aliens would otherwise be taxable on, such as certain types of business, U.S. source business income, and certain types of U.S. source passive income, which, you know, is few and far between, really. It's basically U.S. dividends.
Yeah.
Okay.
So we go
Anything
from
to say about
nirvana to hell.
Nirvana to hell. I think those are two different
Potential
religions, isn't it? Like nirvana and hell are two different religious constructs. Anyway,
I'm
whatever, you
I'm
understand.
open like that, Amy. I'm not so rigid that way.
Yeah, we coexist. All right. This is narrative of the next slide. Yes. All right. So here's what we're really here to talk about today. Why did it take us so long to get here? Well, I mean, I don't know. I guess we like to hear ourselves talk. Okay. So if you don't have a foreign trust with a U.S. owner, you don't have a foreign trust with a foreign owner, you don't have a trust with an owner. A trust without an owner is called a non-grantor trust. So we have foreign non-grantor trusts. So this is what Milan refers to as hell.
Potential hell.
Potential hell. Yeah, it's not total hell. It's not, yeah, don't get scared. It's not to be avoided at all costs. There are some opportunities, but the overview, the high level consequence of a foreign non-grantor trust is that the trust itself is treated like a non-resident alien taxpayer and does not file U.S. tax returns, unless there's certain types of U.S. source income that were not withheld at source. And you're like, well, why is that hell? That sounds pretty darn good.
Yeah, right. I think it's the next slide. Is that where yes, this is where
I think so.
This is where the problems can happen, or opportunities, right?
Opportunities. Okay.
Problems can be turned into opportunities.
Right. So, it's all well and good. You got a foreign non-grantor trust, but we wouldn't even be talking about this here if we didn't have a U.S. beneficiary involved in that trust.
Right.
We don't really care unless there's a U.S. beneficiary. And the beneficiary starts to really care when distributions are made to him or her, the U.S. beneficiary. So whenever a U.S. beneficiary receives a distribution from a foreign non-grantor trust, that distribution will be reported, and that distribution will carry out certain tax attributes of what has occurred in the trust. So there are tiering rules or ordering rules that are imposed upon the distribution, which is whenever a beneficiary receives a distribution, what is deemed to first come out is the current year income of the trust, also known as D&I. Then, to the extent that the distribution exceeds the current year income, the distribution will be deemed to consist of prior year accumulated income that was not distributed, or U&I. This is the thing that scares people, the U&I. It's a thing that can, just requires a lot of planning and whatnot. So, and then, and only then, until all of the D&I and U&I have been exhausted, we dip into non-taxable corpus. So is the next slide where I do the picture?
This is your little picture. Yep. Your
I
coloring,
know, but
your
you put your
coloring
colors on
project.
it just looks so much better in my colors. These are not my colors, but it is my picture. Okay. Example. U.S. beneficiary has received a $400 distribution from foreign non-grantor trust under those ordering rules that I just talked about. D&I, so in this example, the trust has $100 of current year income. It has $200 of prior year accumulated income, or UNI. So when that beneficiary receives the 400, that distribution is deemed to be first $100, subject to ordinary tax in the hands of the beneficiary. Then the next 200 that comes out is considered UNI and subject to ordinary tax plus this thing called the throwback tax that we're going to talk about. And then the remaining $100 is non-taxable corpus. All right.
I think you go. I think we kind of.
Did I do that? Oh, well, I do want to highlight that the that first tier of distribution, the D&I, the current year income, it retains its character in the hands of the U.S. beneficiary who receives it. So, for example, qualified dividends remain qualified, long-term capital gains get long-term capital gain rates. If multiple beneficiaries receive distributions of the same year, the D&I is allocated to them. And keep in mind that as long as distributions are equal to or less than the current year D&I, we don't even get into the throwback tax regime, which I think I talk about next. Okay.
Tax. Yeah.
All right. How am I doing on time? I feel like I need to speed up.
You got 8 minutes.
Okay. All right. So let's talk about what happens when a distribution greater than D&I is made. That is called an accumulation distribution. This is the thing that's subject to the throwback tax rules, which is just a fancy dancy term for an interest charge. And keep in mind that just like the PFIC rules, the CFC rules, all of that, the throwback tax regime is an anti-deferral regime. It essentially aims to recreate the U.S. tax that the beneficiary would have paid had the UNI been distributed in the year that it was earned. Okay, so that's why we have the interest charge. It's like the beneficiary's filing an amended return for all those years. Okay, but here's the kicker: is that let's see, long-term capital gains, qualified dividends, they go to ordinary. You don't get those preferred rates anymore. And the interest charge goes back to the year it was earned, even if it was before the beneficiary was born, even if it was before the beneficiary was a U.S. person. And that's
the nastiness. That's where that's where it gets nasty.
Yeah, and that's a unique rule. Oh, I should say, some of you out there who know trust taxation generally, you're like, why the heck are we talking about capital gains to begin with? Well, because in U.S. non-grantor trust land, capital gains are not D&I because they're considered an event of the corpus of the trust. But in foreign non-grantor trust world, capital gains are considered D&I that must be distributed. Otherwise, they become UNI. All right.
Right. Yeah, that's a lot when you're dealing with non-U.S. trusts. That's a big point of confusion with the non-U.S. Advisors who think income doesn't include capital gains, but for U.S. tax purposes, exactly.
Yeah, which is an appropriate assumption in all areas other than foreign non-grantor trusts with U.S. beneficiaries. Okay,
I think this is covered on the slide.
I think I pretty much did. The only thing that I do want to say is that the reason people are scared of UNI is because that interest charge can get so gigantic that it will actually eat up the whole distribution. So,
yes. And
so
based on everything Amy said, I love this slide. So Amy has her little slide. This is my little slide to visually represent how the problem with the throwback tax, if it's not managed properly, and Amy's going to cover how some of the ways that you can mitigate it in 3 groups, but this is just a quick visual for you to see what we're talking about. So in that example where there's a distribution of the UNI portion, over time, because of the interest charge is what's causing this. And they call it interest charge, but really it's a penalty for all intents and purposes. And you can see as time passes, the UNI, the interest charge on that, not only do you have the negative tax consequences where all the favorable tax rates go to ordinary. Then you have the interest charge. You can see within, and it's based on each case, but around 15 to 17 years, the interest charge and tax will equal the UNI amount. So you're not going to have a happy client when they find out that, yes, they got, let's say in that very small example, what was it, $300 of,
Yeah.
or $200, I think it was $200 of UNI. Well,
Yeah.
$200 is going to Uncle Sam. That's the not so great part of it. So Amy's now, I think you're going to cover some the broad level, high level mitigation.
Okay, mitigating the throwback tax. Okay, so it basically breaks down into three categories. The first and most common is what we call election strategies. This first one, distributing all of the DNI from the trust every year, is kind of the most common. And we're talking about mitigating, right? So this just avoids creating any more or any, depending on when you catch trust, a UNI. Fortunately, when I was a baby attorney, I was like, wait, I got to distribute it all on December 31st. And then I was like, how will we know? We're going to be up till midnight trying to calculate. Anyway, yeah, that was just, you think I'm smart, but I'm not. That's how I was initially thinking. And then I was like, oh, you have 65 days to calculate that DNI. And then you can elect to treat that DNI as having been distributed on the last day of the calendar year. So we also have some other little fancy things, this default method. We won't get into that. And then this other thing that Milan put on there that I don't think I've ever done, so I'm not going to say anything about it.
We can maybe get into it later.
Yeah,
I had it come up in one case where it helped us out, where it was still part of the decedent die, but we invoked the 645 election, and we were because there was litigation. To buy you
some more time.
There was 6 years of litigation going on, so there was no distribution, so we couldn't do anything, so we couldn't distribute, and so we invoked this, and we were able to get out of the UNI problem.
Okay, so you bought yourself 2 years worth.
No, 6 years. Yeah. Oh, yeah.
Years.
I got 6 years. Yeah.
Oh, okay.
Very, very clever.
You are.
Yeah.
All right, moving along. Part 2, distribution strategies. Okay, so let's see. There are specific exceptions to the carrying out of DNI and UNI under the regs, and a few of these are listed here. I do want to say, you can go back and look at this and whatnot, but I will say that some of these distribution strategies, other than the charitable distribution strategy, and yeah, basically the first three, will not prevent the creation of UNI, because these types of distributions don't carry out DNI or UNI, or actually the second two. So anyway, so there's some ways that you can use certain types of distributions to mitigate the throwback tax issue. Some of these, just be careful, they don't mitigate UNI.
Yeah, so. And I'll say it differently. If just the way I look at it is what Amy's saying is that when you, particularly with the first three, if you have UNI, it doesn't take away the problem. It only keeps it managed. We're going to get into how there might be some ways to cleanse it where you actually get rid of the UNI, right? I'm sorry. Right. I spoiled your thunder.
I don't care. I'm just trying to get back to listening to Life of a Showgirl. How much longer do we have? Okay. We're part 3. Good. The final one, restructuring and investment strategies. So you can just see them listed here. Milan's favorite is the general power of appointment strategy. And
that's a pure cleanse.
Yeah.
It's a restart.
Yes, right. And the other 3, domesticate, that these are just kind of mitigating the income issue again. And then the last one Milan would call my favorite.
Yes.
Is investing in PPLI, which it doesn't cleanse, but it has some pretty cool things.
I think there's some debate on that one.
Yes.
But we won't get into that.
Yeah, it's a whole presentation itself. So
that is a whole I think we should do that one. Maybe we'll work on that one. Anyway.
Right.
So that's yeah, someone asked if the slides are going to be available. Yes, we're going to distribute the slides as well as the recording after it'll take, I don't know if Joe's on here, but it'll take Joe maybe a couple days to get it out.
And the presentation will also be up on your YouTube thing. Yeah, so if we're going super fast, that's on purpose because we only have an hour and we're trying not to get too much in the weeds. So okay,
so now we get to I just before I get to the reporting issue, because I know everyone's excited, that's the most exciting part of this, filling out forms. But it is I just just quick review, since we have a couple minutes, is that I just wanted, so we talked about classification, right? Is it a trust? Is it a domestic or foreign trust? And since we're talking about foreign trust, is it a grantor or non-grantor trust? And then Amy went into the details of when you have a U.S. settlor with a foreign trust, it generally automatically falls into being a grantor trust under 679. Then we have what we call nirvana, where you have a non-U.S. person who sets up a foreign trust, but only qualifies because under there, the default rule, like we said, under the U.S. rules, it's a default foreign trust. If you have a non-U.S. person setting up a foreign trust, the default is it's a non-grantor trust unless you meet those two exceptions that Amy pointed out. And then we have a foreign trust that's a non-grantor trust that has this unique issue of issues with UNI and DNI. Okay, on to reporting. My favorite issue. So let me just say this. I'm not going to actually get into the details about reporting, other than to say the U.S. gets extremely nervous anytime there is not foreign reporting. Anytime money goes outside of the U.S., because the IRS doesn't get that information fed to it. Kind of does now through FATCA, but in the past it didn't get anything. So they were always fearing anytime anything went offshore, people were going to evade taxation. As a result, our rules are based on the fact that there's a lot of reporting, not necessarily income taxation, but there's a lot of reporting. They want to know what's going on and who's involved. And that's really what this all stems from. So I'm only going to highlight a couple of in particular with foreign trusts, what the reporting is. There's really two main ones. The first one is Form 3520A. What's unique about 3520A is that while it's an obligation for the U.S. taxpayer to file this, and this is that situation where you have a U.S. settlor, this is the most common. U.S. settlor sets up an asset protection trust. Under the automatic rule, it's going to be a grantor trust. That U.S. settlor, even though it's an asset protection trust in the Cook Islands, it's a grantor trust for U.S. tax purposes, a foreign grantor trust for U.S. tax purposes. That settlor grantor has to file an annual 3520. The obligations on the settlor, U.S. person.
So I'll like editorialize this a little bit, which is this is a form filed by the trustee of a foreign trust with a U.S. owner, but the obligation, because as much as I've said this before, as much as the IRS in the United States would like the whole world to think that it has taxing jurisdiction over over the whole globe, it knows it doesn't. So it shows up in these rules where, we only have jurisdiction over the U.S. owner. We don't have jurisdiction over the foreign trustee. So the U.S. owner is obligated to ensure that the foreign trustee files this form.
Yes, exactly. And so with that, one of the obligations or requirements that trustees have not only with providing or signing the 3520A on behalf of the U.S. beneficiary, is to provide what's called a foreign grantor trust beneficiary statement, as well as a foreign grantor trust owner statement. We're not going to get into the details of that, but those are just to be aware of. If you're a trustee with one of these, those are two very important. And the penalties we'll get to very quickly are massive if you don't do this. There is a default rule. If the trustee for some reason doesn't provide it, then the obligation then can be done and met with by providing a substitute form 3520A.
Right.
Then if you have distributions to a U.S. person, if they're the grantor, they're going to fill out part 2. And if there's an actual distribution, it goes in part 3 if it's a grantor. And if they're not a grantor, but just a U.S. person who receives a distribution, they're just doing part 3. There also, if there's distributions to the foreign trust, those have to be reported in part 1. So it's somewhat duplicative, but it's not. It's just more reporting. IRS wants it. So those two are the two most important ones with foreign trusts. I'm not going to, I covered the foreign grantor trust beneficiary statements. There's one also for a foreign non-grantor beneficiary statement. Both of those are critical. So if you're dealing with this, don't overlook those. They are important because otherwise negative tax consequences. I am going to just highlight the penalties. It starts at $10,000 per year. It can be as high as 35% of the amount that should be reported, or 5% of the total assets. I'm dealing with one case right now where a U.S. accountant didn't do the proper reporting. Client had a significant amount of money. The penalty is upwards of $1 million. It's not pretty. No bueno, Amy.
No bueno at all.
Which is why it's really important to get good advice up front to avoid these situations. These are just a host of filing for foreign reporting. You can go read these on your own.
Yeah.
Have fun. Have fun. Oh, yes. Thank you. There's a question. I did skip over it, but I think it's a good one. The question asked was the U.S. agent form. It's not technically a tax filing. It's an agreement between a U.S. person. It must be a U.S. person. It doesn't have to be an individual, just a U.S. person as defined under the code, and the trustee. And what that does is that it allows, so once again, because as Amy pointed out earlier, because the IRS doesn't have subpoena powers and summons powers, that it has massive powers over people in the United States. None of that exists outside without going through very complicated and difficult and long procedures to get records from non-US jurisdictions. So, because the IRS is well aware it's very difficult to get records outside of the US, they came up with this US agent rule, which says if you don't want to provide all your trust documents and amendments and who's a beneficiary and all this information that, quite frankly, I don't think the IRS should have in their possession unless requested or necessary, you have appointed a U.S. agent who then agrees to be subject to summons or subpoena powers or court orders and provide those records to the IRS or court. Now, I've been doing this for 25 years. I've been an agent in hundreds of trusts. I've yet to ever get a request. I don't know. Amy, you?
Right. Yeah. Yeah. Same for me. And I have, so just note that it's an agent. I call it a tax agent. Like the foreign trustee is only appointing this U.S. person to be available for the IRS to reach and get tax information. Okay. So number one, I also have foreign trustees are like, if I appoint an agent in the U.S., is that going to make me foreign trust company with no U.S. operations or anything subject to the jurisdiction of the U.S.? The answer is no. So the primary and really sole purpose is to give the IRS the name of someone to get information in order if they have questions about the proper taxation of a distribution from a foreign trust. And so And it just makes it easier, because if you don't appoint a U.S. agent, then you got to attach. Well, I mean, you got to like.
Yeah, you got to give everything your. I think you even have to give a blood sample, Amy. Now,
Yeah,
I'm
I was
kidding.
gonna say
I'm
open the
joking.
kimono. I was gonna say you have to open the kimono, but like, you know.
Basically, that's that. See, this is why we have the label. You have to open the kimono. Thank you, Amy, for making sure we properly use that label. Yes, you would, as
I
Amy
was
said.
waiting for an opportunity to be inappropriate so that I
Yes,
could.
very
Yeah.
well done. Well done.
All right.
So that's
Great
you don't want
question.
that.
Great question.
Yeah,
Great
great
question.
question.
Thank you.
So, Amy, we are literally right on target. So we get to talk about some special issues involving foreign trust. So you want to start with your two favorite?
I will start. And in fact, so you make fun of me for talking about hybrid trust and reverse hybrid trust, but the fact that this is important was evidenced by somebody asking a question about this. Okay, so in the past, so there are certain reasons why if you have a U.S. client creating a foreign trust, we there are some estate gift and capital gain type tax reasons that you would not want certain types of trusts that have a foreign trustee to actually be classified as a foreign trust for U.S. tax purposes. So what we would do is appoint a U.S. co-trustee. We put all sorts of substantial decision language in there, savings clause stuff. We make sure that the foreign trustee is seen to be more carrying out the substantial decisions that are made by the U.S. co-trustees, so that it's foreign for all other purposes. If a client wants to avail themselves of the great trust laws of the Cook Islands or Liechtenstein or whatever, so the governing law is that foreign jurisdiction. So it's foreign for all trust purposes, and we just make sure that it passes the court and control test so that it's U.S. for tax purposes. Okay. And then in more recent years, I had the opposite kind of begin to occur. And I don't know if anybody else calls it a reverse hybrid, but that's what I started calling it. It's the opposite of that. So let's say, for example, we have a Wyoming trust for all trust purposes, but we intentionally fail one of the control test options. So you have a Wyoming trustee, and then maybe we give a foreign person like the power to remove and replace a trustee so that it is foreign for U.S. tax purposes. I saw a lot of this happen kind of after CRS was passed. I saw a lot of like foreign families kind of migrating their trusts from other jurisdictions to the U.S., but because they had no other U.S. Anything, we wanted to make sure that it was foreign for tax purposes, but it was a U.S. for CRS purposes, because the United States has FATCA, and we want everybody to be reciprocal in the tax exchange. And then when the rest of the world said, "Oh, we'll be reciprocal with CRS," and the U.S. was like, "Well, we'll sign on to that, not." And so, basically the U.S. is a CRS haven. I don't even know if I'm allowed to say that out loud, but just FYI. So that is hybrid and reverse hybrid. And there's a question.
Yeah, the question is can you set up a trust in the South Dakota jurisdiction? I mean, I guess, well, you can answer it. I won't.
Yeah. I mean, so I do like asset protection is a large part of my practice. And I also, it's good. These domestic trust jurisdictions like South Dakota, Nevada, and all those are great also for non-resident alien like generation one wanting to gift into the U.S. to their U.S. beneficiaries. And it's good to put those into, a nice trust jurisdiction like South Dakota. So does the foreign trust formed in the U.S. need to make FATCA filings? So I think we're talking about the reverse hybrid trust.
I think the reverse. Yeah, I think that's what.
Yeah. So because it's a foreign trust for tax purposes, it's not going to be required to file like any U.S. tax returns. I always get a little bit stumbly on FATCA because it encompasses so much.
Yeah, I mean, in this, I think the simplest situation, it would not be FATCA reporting because it's foreign and there wouldn't be and the trust would be respected. So that would more likely than not require, but that's, I think that gets very specific.
Yeah,
and
because
you need to know
if it
FATCA
has like
terms.
U.S. beneficial
So
owners, you know, and of
you have
course,
to look through the whole structure. So we can't give you like a very general answer here because it's hard to say without knowing all the facts and circumstances.
right, yeah, and you know, and in my head, FATCA also encompasses which U.S. tax withholding certificates the trust has to give to custodians paying U.S. source income. So,
Right.
let me just say, high level, FATCA. You have to kind of look at the FATCA stuff. So we kind of assume, like, does FATCA apply to this structure, and then go from there. So sorry, I'm sure that was an annoying answer, but
Yeah.
it's very lawyerly of us.
But
It depends. That's the lawyer answer. Well, it depends.
It depends, but I do think it gives a good segue into the issue of, you brought up, the reverse hybrid, where let's say we have the example of, this isn't, you have a non-US person. Let's say there's no US beneficiaries. They're simply setting up a Wyoming trust, South Dakota trust, Nevada trust, but it's a US trust, but it's foreign for classification purposes. Okay, because they want to buy real estate, or they want to invest in the U.S. securities market, right? Great. America's very happy. Great tax benefits with regard to securities, zero tax. FERPTA comes into play when it comes to real estate, but we won't get into that. But anyway, there are reasons for diversification, political instability, whatever. They want to do this. A little issue that comes up that doesn't necessarily get addressed, but it's really important, is that if you are a non-US person and there's no treaty with the United States for estate and gift tax purposes, the general rule is the exemption, while it's for US citizens, 15 million if you're married couple, 30 million exemption for estate and gift tax purposes. Amy, what is it for a non-US person?
$60,000, and that hasn't changed since I don't know when. So
I don't know. It hasn't changed. $60,000. So it's and the rate, Amy, at above.
It's like almost 50%, right?
Yep. So 50 up to 50, close to 50% is going to be taxed. The main point here is there are ways to mitigate or address that issue by putting in a blocker. The other thing is, let's say they didn't get proper planning and put in a blocker, and now they're subject to the estate tax. It's going to take a while to get those assets out because you have to go through this process with a transfer certificate. And because the custodians are in the US and they would be personally liable for the tax if not paid, they are not releasing this until the IRS gives you this transfer certificate. That's just to highlight.
And you can do all sorts of jumping up and down, telling them that it doesn't apply. They're going to want it anyway because they're on the hook.
Yep. They are not going to care. They want that certificate. And the IRS it takes a while to do it. And so just be aware of that little problem.
I do want to mention with FERPTA though, just be careful, like, that to have this blocker, you want to close on the US property within the blocker. You don't want to put it into the blocker because that could be a deemed disposition. So
I think that's another seminar we can do, webinar on real estate structuring, because that's a whole nother.
Yeah, there is so much non-billable stuff we could do, Milan. It's going to be great. Okay. So was that what you wanted to say about that? Let's go move on.
That's it. That's all. Yep.
I'm watching the clock. So
yeah, we got 6 minutes.
Strategic distributions. All right. So this one I will use pretty often. So let's say you have a foreign non-grantor trust with a bunch of you and I, which we know is the nasty stuff. That's the hell potentially. But the trust has a class of beneficiaries, some of whom are US people and some of whom are not. And so nothing in the throwback tax rule says that the UNI has to come out to a U.S. person. It just needs to come out, because what the IRS is doing is we don't want a forever like tax deferral opportunity for U.S. people. So we just play by their rules, and we do distribution. We could cleanse that UNI out via distributions to the non-U.S. beneficiaries year 1 or 2, or however long it takes. And then in the next calendar year after it's been cleansed, now you can start making distributions that exceed the DNI to the U.S. beneficiaries, and voila, we don't have a throwback tax problem. So I think this is where I say don't be cute, though, because I know what you're thinking.
Yes, I was waiting for you to say that.
I know.
Don't be
well,
cute.
I mean, because we're all so much more creative and smart than the IRS and the Congress that makes the laws. So they're constantly like running around trying to pass laws to close the loopholes that we find in their rules. So anyway, so one of such loopholes is, oh, wait, I could make a big old distribution to non-US beneficiary, and the non-US beneficiary can decide to gift that over to a US beneficiary. No, no, that's going to be collapsed.
No bueno.
No bueno. The other thing I should mention is just, you cannot make the big distribution to the US and non-US beneficiaries in the same year because of the rule that says that each beneficiary who receives a distribution receives a pro rata allocation of the DNI and UNI. So if you're going to do a cleansing UNI distribution, you got to do it year 1. And then once the UNI is exhausted on that distribution, then year 2, you can start making distributions to US people. Okay.
We got 4
Next.
minutes. I'll since we already covered the GPOA, I'll just quickly repeat. It's a great planning technique when you have a UNI problem. There's only limited circumstances where you need another non-US person to basically reestablish the trust, resettle the trust, and you get a fresh start. It's a beautiful technique in the right circumstance. It can fix it's like a magic wand if it applies.
Yeah. And it's also in the realm of, I've done probably in the 20 years I've been able to do this twice, where the foreign settlor just basically undoes the trust, takes the assets back, and we start with a new trust that's better.
Yeah. Well, and I'll just put a little fine point on that. And the times I've done it, we don't actually take the assets out. We resettle. We do an appointment so that we don't have a tax issue in the home jurisdiction.
Right. Okay. What's next? Let's see. We got a few
3 minutes.
Yeah. So outbound trust migration. I put this on here because I just want to say beware of a U.S. plain vanilla normal non-grantor trust here in the U.S. that becomes a foreign trust, because let me give you the example. I had a client who's a beneficiary of a trust that dad had created many, many years ago under New York law. It was a non-grantor trust here in the US, filing its own tax returns. So basically dad made the gift and was like, I'm out. He didn't have to worry about picking up any trust income because it was a non-grantor trust. In the interim, son and dad get super crossways with each other and hate each other. I think they're even in litigation with each other. And the son decides that he wants a Cook Islands trustee. Oopsie, dad is now the owner of that trust under Section 679. And there was a whole lot of talk about, do we tell the dad?
Yeah.
Anyway, because technically, dad needs to be filing 3520, 3528 penalties and all that kind of stuff.
We talked about that notice exception, but this is a tricky area. And that's a good point, is that automatic rule can come back and hit you if you're not aware of it, if you have an outbound trust. Right. We got 1 minute. I'll hit inbound. The only thing I'll quickly say here is that just be aware. People think, oh, if I set up a foreign trust and they're coming to the U.S. for 5 years, for 5 years, and they're going to be subject to the U.S. taxation rules. They set up this trust pre-bound immigration planning, 5 years, they think. But the thing that can hit you bite you in the ass is this
It may still
retained power.
be a grantor trust because of
Right.
retained powers. Yeah.
So it's just be aware of that. So the 5-year rule doesn't mean it's per se, you got to get that checked by someone properly.
But I also want to say that the 5-year rule is not that bad. I would rather many times be under the 5-year rule than have a foreign non-grantor trust, right?
Maybe,
so people
but unless
think
you're going back out.
unless you're like, I'm just here on temporary assignment,
Yeah.
you know, so.
Anyway,
Um,
just to be aware of.
yeah. You mentioned protective filings. The old foreign trust, I was just trying to make it an even number of bullet points, so it's not really.
Yeah, my last plug for filing, since it's such an exciting area. So, people are always like, oh, I have to file. I will tell you, just in practice, sometimes filing is good. And the reason why it's good, Amy?
SOL. So you're not SOL with SOL.
Not shit out of luck.
See, look, you're inappropriate too. Okay.
Yeah. All right.
Yes,
well,
it starts the statute limitations running so that you're not SOL.
Exactly.
Okay.
So protective filings can be your friend where you file something, statute starts running. IRS has, in general, 3 years, sometimes under certain circumstances, 6 years, as long as it's not a willful filing, a willful violation. So it can be your friend. Thank you.
And we ended only 1 minute late. And
we have we'll share the slides. Our contact information is here. Feel free to reach out to either one of us. Happy to talk to you about other issues. Thank you all for joining us. It's a pleasure, and thank you.
Thank you.
Thank you, Amy.
Bye.
Bye-bye.